is pretty steep to me. I mean, you don't even, I'd rather spend on the wallet. It's 52-week low, by the way, on Starbucks shares in today's session. Steve, what are you watching next week?
Let me start off with saying Starbucks on an outside day too, so maybe Nadine is right. I'm watching Alphabet because I want to see if Alphabet's going to take a page out of Apple and Microsoft and continue the momentum in the market for the large cap tech sector. And just think about everything that people are searching to get back to their lives: hotels, airlines, an endless amount of things. Google or Alphabet probably will put up good numbers, and that should be enough to keep the average investor in the market.
People forget about the leverage they have to travel and travel searches, Bonawyn. Are you feeling good about Alphabet going into earnings?
I always feel pretty good about Alphabet. Listen, it's a pretty ubiquitous name. I think it gives you a general pulse on the market. I actually don't see the downside risk that I do in some of the other names. So, given what we've seen from some of the other large cap names that have pricing power and are have a very broad type of branding and presence, I think it sets up pretty well.
All right, up next, final trade.
Remember, we don't watch ads here.
Is that?
No ads. Final trade.
Globally. Bono and Ison.
RTX Raytheon gives you an opportunity to add a little defensive posture to your portfolio.
Steven Grasso.
Apple, it's your everything stock. Value, growth, and we're going to start talking about that $3 trillion market cap again sooner rather than later.
All right, that does it for us. For this hour of Fast Money, do not go anywhere. Options Action is up right after this.
Okay. On to options action. Remember, we don't watch ads here.
Let's get right to it. We're kicking things off with a smoking hot stock.
No. Oh, I didn't record that. Sorry, guys. Let's see what's live then. No, we don't want power lunch.
Tonight on Fast Money at 5 p.m. Eastern. That does it for us. Power Lunch picks things up right now.
Alright, whatever.
Kelly, I think I've got a hyperextended trading elbow from all that crypto stuff that I've been doing. All right, welcome everybody to Power Lunch. Tyler Matheson here, and here is what is ahead for you. 7 rate hikes this year. That's the call from Bank of America, and we will talk to the economists behind that report and what a more aggressive Fed could mean for the market and your investments. 7 hikes. So, demo the reno trade. As rates rise, home improvement spending may hit the brakes, and that could create a whole new class of stock winners and losers in the year ahead. We'll peel that one apart. Plus, high energy, nat gas on pace for its best week since August 2020. We will talk demand, supply, and whether Russia is the big wild card. Kelly.
All right, Tyler. Hi, everybody. Looks like we're going to end the week as we began with these big intraday swings. Dow's near session highs right now of 200 points. Earlier, we were down by 500, so that's quite a big turnaround. It's actually the laggard today. The S&P up 1.3%. The NASDAQ up 1.8%. Tech really leading the way. Small cap struggling. That index more than 20% off its high for the Russell. Some concern about the unprofitable companies in it. Here you can see the declines as it tries to hang on to 1/3% gain today. And earnings, a huge factor in this market. Visa and Apple leading the Dow higher following their results. Visa's up 9%. That's like triple what it was up in all of 2021. Apple's up nearly 6%. Flip side, Caterpillar and Chevron are lagging. They're some of the worst stocks in the Dow, down. In Caterpillar's case, 5%, a little more than 4% for Chevron. Cat cited higher costs in the quarterly report, a little bit of China softness too. Chevron's profit fell shy of expectations. And much of the uncertainty in the market is due to the Fed and the speed at which they'll hike interest rates. So on that note, Bank of America Merrill Lynch out with a bold call this morning, calling for 7 rate hikes this year. Concern is that could weigh on growth. Let's welcome the economist behind this report, Ethan Harris. Ethan, you're like the least provocative person I could think of. You know, if this came from anywhere else, I might just dismiss it. But from you, I take it quite seriously. So what's changed in your mind here?
I mean, I'm such a nice guy. I wear sweaters on TV. Yeah, I mean, listen, the Fed, I think the Fed has finally admitted that they're behind the curve. It doesn't make sense to have a zero funds rate with how fast the labor market's improving. The unemployment rate's already down to 3.9%. It's still falling very fast. We obviously have seen some very high inflation readings, and they're persisting a lot longer than expected. So what does the Fed do about it? How do they catch up? The consensus is they go once a quarter. In my mind, that's, you know, that might have made sense if you hadn't had such a significant,
What's up, Hunter?
such a
My investing plan for this year is to buy ETFs. I'm primarily buying VOO, VT, and VHT.
look at the inflation numbers, which are going to come down very slowly and then hike again. And so I think ultimately they hike 7 times this year, probably a few more hikes in next year. But you can't catch up going once a quarter.
What's the risk that that really slows the economy, and then at that point they take their foot off the brakes?
Yeah, I mean, that is the main risk here. And it's been the risk of them waiting so long. Why not start hiking, you know, a few months earlier so you can go even slower? Well, I do think it's a challenge to the equity market. I think the correction in the market in the last few weeks makes a lot of sense. I mean, the markets had blown through inflation warning signs, in part because the Fed told them, don't worry about it, and we're not going to react to it. It's not a problem. Well, it is a problem. And so the equity market has corrected from that rally. And as the Fed goes forward, the market's only priced in for this year about 4 or 5 hikes. So we've got 7 in there, and there's going to be a little bit more, rough moments in the markets. I don't think it's a bear market. I just think rough moments. The economy is much helped.
So I don't think the bear market will continue by the end of the year. So maybe a couple more months of downside. But I think the supply chain and the inflation stuff will get much better by the end of the year. But who knows?
And then by next year, we start to see more of a slowing as rate hikes start to take a real effect.
I'm curious, Ethan, when, you know, the reaction among most seems to be, you know, when they see 7 hikes this year, they roll their eyes.
I don't think we're going to see 7 rate hikes this year.
No way, you know, but what you're saying is not at all some extreme scenario or anything like that. It's why does this economy need that many hikes and need them?
Yeah, they might do like 3 rate hikes and then not like raise rates. And that's when the economy will recover. So if you can hold or have capital to buy, I think the next couple of months will be really good buying opportunities.
They're trying to do what they did in the last business cycle, keep everything, the foot on the accelerator, keep the economy growing, push the limits on unemployment, and see if you can create some inflation. That was fine in 2018-19. It's not fine today. And they've had a bit of bad luck with the COVID crisis and the impact on supply chains and so on. But they're behind the curve. Frankly, the fact that I have gray hairs may partly explain why I think that there's 7 hikes, and that's because I've seen it before. The last business cycle is the last thing we should be looking at, when they hiked slowly to 2.5 and then started to back off. As Powell himself said at the press conference, that episode is a poor analogy to today when there's actually inflation and high inflation expectations. So I don't view 7 hikes as being like out of the ordinary. It's just different.
So this guy's putting me to sleep. So let me know if you have any other questions. If they keep this guy on, I'm probably going to go to bed. So, yeah.
It'll be just below 2%, right about 2%, which is, according to their own estimates, still below the historic norm. I think they still have a little ways to go from there. I do think that as they go further in the cycle and keep testing the limits, at some point they'll discover that they've hit the pressure point. But I think it's going to take a while. And I
Yeah.
do think that we have to remember that when you're fighting inflation, if you're central bank fighting inflation, it can't be entirely painless. You can't treat the stock market like your best buddy. It has to be, you have to take some risks.
Yes.
And that's what the Fed is doing.
All right, Ethan, thank you very much. Ethan Harris.
All right, guys. Thank you for the live. I'll be back tomorrow morning when the market opens. Goodbye.